as we are waiting for the others to come back. So Consolidated, they have only tested once. That was in April 2023. Remember, Consolidated falls on the core area. The core area, remember I say the core area, there are two areas: the area of financial management and the area of financial reporting. So this one falls on the core. So we're going to tackle the group accounts or consolidated financial statement. Consolidated financial statement, and I was explaining that it falls on the core area of our competency, where they are testing the financial management and financial reporting, having dealt with the cash flow. So we need again to know how to deal with the group, and when we are done with the group, still we shall later on do either a single question on group cash flow, because the cash flow that we did, they were not incorporating the group aspect. They were not incorporating the group aspect. So I'll start with the question 1, the group accounts. Remember, group accounts involves acquisition, whether we are acquiring a subsidiary or we are acquiring an associate. The other issues that are normally in the group: computation of goodwill, computation of investment in associate, the issue to deal with intercompany sales, and those rules that I know already you have gone through them for the consolidation, but we shall be explaining some and all of them here, so that it will enable us to be able to calculate these questions and be able to do our consolidation. So I shall start with the group accounts 1, and I will read it through. And the question reads that Pika Limited, a public limited entity, intends to expand its operation by acquiring investment in other entities. On 1st November 2022, Pika Limited secured a 75% equity interest in Shiba Limited under the following terms. The first one, an immediate cash payment at a fair value of 13 per share on 1st November 2022. An issue of 3 ordinary shares of 10 per value in Pika Limited for every 5 shares acquired in Shiba Limited. The fair value of Pika Limited shares was 13 per share at the date of acquisition. The share issue has not yet been recorded by Pika Limited. On the same date, Pika Limited also acquired a 30% equity shareholding in Amua Limited, paying 24 million in cash. So here we are having Pika Limited being our holding company, because it's the one that is acquiring Shiba Limited 75%, and on the same date, and this date is 1st November, we acquired 30% interest or equity interest, 30% equity interest in Shiba Limited. In Shiba Limited. Not in Shiba, but in Amua. They're talking about in Amua Limited, where we acquired that 30%. So the following draft statement of financial position as at 30th April 2023 relates to Pika Limited and Shiba Limited. Pika Limited and Shiba Limited. So Pika, remember, I have said, is a holding or the parent, and Shiba will be our subsidiary in this case. We'll go through additional information. At the date of acquisition, the fair value of Shiba Limited net assets approximated their carrying value, with the exemption of plant, whose fair value exceeded its carrying amount by 10 million. So here the carrying, we are told the fair value exceeded the carrying amount. Remember, carrying amount is a net book value. So net book value was 10 million below, and that's why the fair value was more by 10. We normally call that the fair value gain. We shall say that the plant had a remaining useful life of 10 years at the date of Shiba Limited acquisition. The plant is being depreciated on a straight line basis. The plant is still carried at its carrying value in Shiba Limited financial statement. Still, they are carrying it at net book value. They have not made any adjustment. So no fair value adjustment was necessary on the acquisition of investment in Amua Limited. Remember, Amua, we have said, is our associate because we acquired 30%. On 28th April 2023, Shiba Limited sent goods at an invoice price of 7 million to Pika Limited, which Pika Limited neither received nor recorded until 5th of May 2023. Shiba Limited had marked up the goods by 25% on cost. The agreed trade payable recorded in the books of Pika Limited before the above transaction was 6 million. Number 3, Pika Limited policy is to measure non-controlling interest at fair value at the date of acquisition. For this purpose, the directors of Pika Limited considered Shiba Limited share price of 12 per share to be appropriate. 12 per share to be appropriate. Then the next one, number 4, impairment test performed on 30th April 2023 revealed that goodwill on acquisition of Shiba Limited had not been impaired, but due to declining sales of Amua Limited, the value of investment in Amua Limited had been impaired to the extent of 2 million. So investment in Amua had been impaired to the extent of 2 million. Amua Limited reported a profit after tax of 4 million for the year ended 30th April 2023. Assume that all profit and losses of the 3 companies accrued evenly throughout the year. So you are required to calculate the value of goodwill arising on acquisition of Shiba Limited. They're giving you 4 marks. And determine the value of investment in Amua Limited as at 30th April 2023. Another 4 marks. Prepare consolidated statement of financial position for Pika Group as at 30th April 2023. So that is our question. Now we need first to calculate the goodwill. We need to calculate the investment in associate, that is Amua, and we need to consolidate the financial position. Remember, goodwill, there are normally 2 approaches, whether we are dealing with full goodwill or whether we are dealing with partial goodwill. And for full, the prerequisite for you to use the full, you have to be given the fair value of NCI, the fair value of NCI at the date of acquisition. And we have been given that statement in note number 3, that Pika Limited policy is to measure non-controlling interest at fair value at the date of acquisition. And we are told for this purpose, directors of Pika Limited considered Shiba Limited share price of 12 per share to be appropriate. That means the 12 shillings will be used to measure the fair value of the NCI, the fair value of the NCI. Therefore, we just need to calculate our goodwill arising on acquisition of Shiba, So you can just do it here. Just do it at this end. So this is our calculation. Calculate the value of goodwill arising on acquisition of Shiba. And for the goodwill, we normally start with the purchase consideration, the amount that we paid. Purchase consideration, and we are told in our case purchase consideration consisted of 2 elements. It consisted of 2 elements. Under purchase consideration, that is here, Pika Public Limited intends to acquire on 1st November. Pika Limited secured 75% equity interest in Shiba Limited under the following terms: an immediate cash payment at a fair value of 13 per share. So we paid 13 per share, but remember we acquired what? 75%. So we come to Shiba, we look at the equity. Ordinary shares of Shiba was 80,000, but the par value is what? The par value is 10. Out of these 80 divided by 10, so that you get the number of shares, we acquired 75% of it, and we paid a price of 13 shillings. We paid a price of 13 shillings, which will mean here, so the cash payment cash payment. Let me do it here. It will be this value. Let me use a cell reference 80. Okay, let me use a bracket. Use a bracket 80. I divide by 10. This 10 is a per value. The reason I'm dividing by 10 is to get the the number of shares, and I multiply. Okay, you can close that. I multiply by 75%. What we acquired, those are the number of shares that we acquired, and each share we placed a value of 13 shillings here. An immediate cash payment of 13 shillings per share, but it's 13 shilling of 75% equity interest that we acquired, because we're just dealing with what we acquired. I'll enter. It means the cash payment that we paid to acquire the shares was 78,000, and remember we're dealing with shillings in thousand. Shillings in thousand. Shillings in thousand. So we paid a cash payment of 78,000 to acquire the shares. I've taken the number of shares divided by 10 per value to get the number of shares, then multiplied by 75% and multiplied by 13 shillings. The second part was the share for share or share exchange, an issue of 3 ordinary shares of 10 per value in Pika for every 5 shares acquired in Shiba Limited. Share exchange. Share exchange. Share exchange. And for the share exchange, they are still repeating an issue of 3 ordinary shares of 10 per value in Pika Limited for every 5 shares acquired in Shiba Limited. And you will continue with this. The fair value of Pika Limited shares was 13 per share. At the date of acquisition, the share has not been recorded by Pika, but this one it was issued. Okay, first we get the number of shares that we acquired, because we are giving them 3 ordinary share and it is at par. We are giving them at par. So 3 ordinary shares of 10 per in Pika for every 5 shares acquired in Shiba. For every 5 shares acquired in Shiba. So the same scenario, I'll open the bracket, take 80, divide by the par value, multiplied by 75%, the shares that we acquired. So up to that we get the number of shares that we acquired, and now we gave them 2, not 2, we gave them 3 for every 5. 3 for every 5. So 3 over 5. 3 for every 5. Remember per value is still 10, but remember now we are giving them shares of Pika which are valued at 13. So we multiply by 13 shillings because the fair value of Pika Limited share was 13 per share at the date of acquisition. So we are taking the number of shares divided by 10. Those one gives us the number of shares that we had. 75% is what we acquired. The exchange ratio 3 for every 5 at a price of 13. So that will get that the share for share exchange was valued at 46,800. 46,800. And so this was the 2 purchase consideration that we had. We have the fair value NCI, the fair value of non-controlling interest, fair value of non-controlling interest. So when you look at our non-controlling interest, there is something we are told in note number 3, that Pika Limited policy is to measure non-controlling interest at fair value at the date of acquisition. For this purpose, directors of Pika Limited considered Shiba Limited share price of 12 per share to be appropriate. So remember, when you look at the group structure, we are acquiring 75. It means the NCI are remaining with 25, the balance. Whereby if we were to draw, we are having Pika acquiring Shiba 75, then the balance that remains in Shiba 25 is being acquired by the NCI, and that's why here I'll open the bracket, still come to the Shiba, the number of shares, divide by 10. 10, remember, is a per value, and for them they are acquiring 25%. They are acquiring 25%, valued at 12 shillings. Here, where they are saying that for this purpose, directors of Pika Limited considered Shiba Limited share price of 12 per share to be appropriate. So 12 per share to be appropriate, and you enter. So it means the fair value of NCI at the date of acquisition was 24. And you just need to get the sum of the two. That was the total value that we placed. So our value for the holding was 78 and 46, and NCI placed 24,000 to acquire Shiba Limited. So I suppose to less net assets acquired, and our net assets, remember, we deal with the reserves. Our net assets will incorporate the ordinary. I'll use it here. Now the full value that we have, ordinary share. The other thing, we have the retained. There is a question that we shall ask ourselves, so I'll just write the retained earnings. Pre-acquisition, but we normally use a pre-acquisition retained earnings. We need to know, when did we acquire this company? When did we acquire Shiba? We acquired Shiba on 1st November 2022. That is the date of when we acquired, and we are reporting when? We are reporting on 30th April. So when we count that, it means Shiba was acquired for 6 months. We had it for 6 months, from November 1st, November, December, and the 4 months. So 6 months. We were having it for 6 months. And therefore the pre-acquisition will be, when you look at here, they have given us 2 profits, 2 retained. We have the one for 1st May 2022, and for the year ended 30th April 2023. So if 6 months we acquired it, so for 6 months it was a post, and the other 6 months for this profit for the year, we shall divide it into 2. This 10,800, one portion up to 1st November, it will be pre, that is up to that 30th of October. That part will be accounted as a pre-acquisition, because yes, it is a profit for the year, but it was made before we acquired. But the profit that was made from 1st November going forward, it will be accounted as our post-acquisition profit. And therefore, in this case, to get the pre-acquisition, because of the dates that we acquired, we shall take the profit at the beginning of the year. Remember, year starts on May and ends in April, but we acquired it in the course of the year. So we shall add, we'll just open the bracket, this one for the year multiplied by half, by 0.5 or 6/12. Either use 6/12 or 0.5, because it was only for half an year when it was pre. So 12,800 was at the beginning of the year, but we did not acquire it at the beginning. We acquired it in the course of the year, specifically on 1st of November. On 1st November already it had operated for 6 months, so that profit for 6 months is what we are terming as the pre-acquisition, which is 18,200. 18,200. And the last thing, they had only two reserves, the ordinary and the retained. We shall add in note number 1 where we had the fair value. Remember, it was not accounted for, the fair value gain on plant of 10 million. We shall account for it here. Fair value gain, others call it uplift. Fair value gain of 10 million. Still this one is shillings in thousand. 10 million. And we get the total to get the goodwill. This total. So I'll just put a negative here. And I'll just add the 2. That way. It means we had a goodwill of 40. We had a goodwill of 40,600. This is our goodwill. This is our goodwill. That is our goodwill. 40,600. And we have taken the purchase consideration, which had two elements, the cash and the share exchange, and the fair value of NCI. Then we have less the net assets that we acquired, the ordinary, the pre-acquisition, and we have calculated for the pre. Then the fair value gain, that one gives us the goodwill. So we do the second part so that we shall remain with part C. Let us just tackle part B. Part B of it. For the value, we determine the value of investment in Amua Limited. Remember, Amua Limited was the associate. Which still we acquired at the same period of time, on 1st of November. For Amua Limited, our purchase consideration, let me just undo that. We need shillings in thousand. Our purchase consideration that we put to acquire Amua Limited, we have been told it was 24. It was 24. Even it is included here. Yeah, it is included here. Yeah, the 78 already was here. Amua Limited 24 here, where we read the first, but it is included in the statement. Amua Limited, we acquired it at 24. So I'll put equals to here, and I pick the value directly from the statement, the 24 million. And we normally add the post. We add the post acquisition. Remember, in calculating the goodwill we use a pre, but for the associate we use a post, and at the retained we shall also use a post acquisition profit. Post acquisition profit. We are calling it the post because it was after the acquisition. Remember, for this one we shall just deal with the profit for the year. We are told something in note 5. This was not in the statement. Note 5. Amua Limited reported a profit after tax of 4 million for the year ended 30th April. So the whole year they made a profit of 4 million. But remember, we need our share. We are owning it 30%. And the 4 million was for the whole year, but the post will only be for 6 months when we had it. So 4,000 by 6/12 or by 0.5. We just use 6/12 to show the period, and we multiply by 30%. 30% is a proportion of what we are owning, or what we received 30%. The whole profit was 4, but we received 30, which becomes 600 as our post acquisition profit. But they made a loss. In note number 4, the impairment test performed on 30th April revealed that goodwill on acquisition of Shiba had not been impaired, but due to declining sales of Amua Limited, the fair value investment in Amua Limited had been impaired to an extent of 2 million. So impairment is loss of value. Impairment of goodwill, or we just call it impairment, and that one we shall minus the 2. the 2000, the impairment of 2, and we get the total because that was all under these. That's how the first two parts. We have to calculate the goodwill, which have gotten 40,600, and we have to calculate the value of investment in Amua. So initially we had invested 24, but now the current value stands at 22 because we got profit of 600 and we lost. The value of Amua had depreciated, or it had been impaired by 2 million. It had been impaired by 2 million, and our value now stands at 22,600. That's 22,600. And I will wish to stop at that so that tomorrow we shall continue with part C, where we shall prepare the consolidated statement. We shall prepare the consolidated statement of financial position, the consolidated statement of financial position, and maybe be able to start another and complete it. So remember, there were some questions on the folder for cash flow. So only Jared who has been able to attempt one. There were 2 questions that were for assignment, but your others are yet to attempt them. So when you get time, kindly attempt them, so that you continue sharpening your skills, because still the time is running out, but still we are within our time. We shall be able to complete it on time. So I wish to stop there. So today we have been able to start the group, and in the next lessons we shall be able still to continue until we are able again to get it right as we continue. So I wish you good night until we meet tomorrow the same time for the lesson. Thank you. So that is the question that we were looking at, question of Pick and Shiba, and we only covered part A and part B, part A and part B. And remember, part A is whereby the required was we calculate the goodwill, the value of goodwill arising on acquisition of Shiba, and we saw that Shiba was a subsidiary where we were owning it 75%, and we had acquired 30% interest in Amua, which was an associate, and we had calculated the value of associate. Remember, goodwill we calculated using the full goodwill, because already we were able to determine the fair value of the NCI, which we got 24,000, and there were 2 methods of payment. There was cash payment and there was a share exchange. And that's why we were able to get the pre-acquisition. Remember, we calculated up to the date of acquisition. We saw that we acquired Shiba mid-year, or in the course of the year. We had it for 6 months, from November, 1st November to April, 30th April. So we had it for 6 months, and that's why the pre-acquisition retained earnings we calculated for that particular period of time. For the Amua Limited, which was our associate, we started with the purchase consideration, and we had the post-acquisition profit, and we had an impairment. And that's why we arrived at 22,600 as our value for the investment in Amua Limited, value of investment in Amua Limited. So today we need to do the part C for the consolidated statement of financial position for Picker Group. For Picker Group. So I will do it here. My part C. So we are just starting on the part that of the question that we are doing yesterday, the group accounts 1, where we were only able to calculate as of yesterday you are able to calculate the goodwill and you are able to calculate the investment in AMUA. So in today's lesson, we are looking at part C, where we need to prepare the consolidated statement of financial position. That's where we are starting. That's where we are starting at. We are starting at part C. And welcome for those that are joining. So we look at pick a group. So pick a group. We have just started. Pick a group, consolidated statement. Consolidated statement of financial position. Financial position. As at 30th April 2023. As at 30th April 2023. So pick a group, statement of financial position as at 30th April 2023.
Which number is that?
We are looking at group 1. The first question that we were looking at yesterday.
I was not even there yet.
You are not yesterday.
I didn't know that you had a class.
Okay, so we were having a class and we had communicated that because we postponed the class for Monday. That's what we were doing yesterday. Yesterday we finished on the regression, and then now we started on the group. And this question you are to download if you have not downloaded from the folder. Yeah, the consolidated financial statement. Consolidated financial statement. So we were only able to do part A and B when we completed the regression yesterday. So we started on group and we did part A for the goodwill and part B for investment in associate, because when we read, we saw that we are having a company by the name Pika acquiring Shiba, and we acquired Shiba 75%, which made Shiba our subsidiary, and we invested in 30% of AMUA, which made AMUA our associate, and that's why we calculated A and B of the required, the goodwill and the investment in associate. So today we are doing the part C. We need just to create or to prepare the consolidated statement of financial position. Consolidated statement of financial position. I'll just read through the additional information, or I can just start at the beginning so that we are at par on the flow of the question as we start preparing the consolidated financial position. So I'll start reading. Pika Limited, a public limited entity, intends to expand its operation by acquiring investment in other entities. On 1st November 2022, Pika Limited secured 75% equity interest in Shiba Limited under the following terms. The first one was an immediate cash payment at a fair value of 13 per share on 1st November 2022. An issue of 3 ordinary shares of 10 per in Pika Limited for every 5 shares acquired in Shiba Limited. The fair value of Pika Limited share was 13 per share at the date of acquisition. The share issue has not been recorded by Pika Limited. On the same date, Pika Limited also acquired 30% equity shareholding in AMUA, paying 24 million in cash. So the same date is on 1st November 2022. So I've been given the draft statement of financial position for Pika and for Shiba. Then additional, as at the date of acquisition, the fair value of Shiba Limited net assets approximated their carrying value, with the exemption of plant whose fair value exceeded its carrying amount by 10 million. The plant had a remaining useful life of 10 years at the date of Shiba Limited acquisition. The plant is being depreciated on straight line basis. The plant is still carried at its carrying value in Shiba Limited financial statement. No fair value adjustment were necessary on the acquisition of the investment in AMUA Limited. On 28 April 2023, Shiba Limited sent goods at an invoice price of 7 million to Pika Limited, which Pika Limited neither received nor recorded until 5th of May 2023. Shiba Limited had marked up these goods by 25% on cost. The agreed trade payable recorded in the books of Pika Limited before the above transaction was 6 million. Pika Limited policy is to measure non-controlling interest at fair value at the date of acquisition. For this purpose, the directors of Pika Limited considered Shiba Limited share price of 12 shillings per share to be appropriate. Impairment tests performed on 30th April revealed that goodwill on acquisition of Shiba had not been impaired, but due to declining sales of Amua Limited, the value of investment in Amua had been impaired to the extent of 2 million. Then Amua Limited reported profit after tax of 4 million for the year ended 30th April 2023. Assume all profit and losses of the three companies accrue evenly throughout the year. So that's why the required was calculate the value of goodwill arising from the acquisition of Shiba and determine the value of investment in Amua Limited as at 30th April 2023, and then prepare consolidated statement of financial position. So that was our question that we had. So for the consolidation, there are some workings that we need to work on first. We need to work on working in note number 1, where we had the fair value. We need to calculate the fair value depreciation, which we normally call it depreciation undercharge, because the calculated depreciation based on the carrying amount, which was less by 10 million because the fair value was more by 10 million. Then we need to calculate the intercompany sales. We calculate the unrealized profit on that particular element in note number 2. I think those are the two major first. Then we continue with the others. So I'll do my workings. Okay, let me do them here. My assumptions or workings. Let me do my workings here. And working number 1 will be for the fair value depreciation. Fair value depreciation. And this was an item of planned in note number 1, where the fair value exceeded the carrying amount by 10 million. The plant had remaining useful life of 10 years as at the date of Shiba's acquisition. The plant is being depreciated on straight line basis. So this 10 million it is for plant. So 10 million, which is 10,000, because we are dealing with shillings in thousand. I will multiply or divide by 10 to get the depreciation per year. But remember, we only acquired it for how many months? For only 6 months. We had this item or this plant for 6 months, so we shall go with the pro rata 6/12. We are taking 10,000 as our fair value, divided by 10, then by 6/12, which will give us a depreciation of 500. So later on we shall apportion. Remember, this depreciation of 500 belongs to both the holding, that is Pika, and the NCI, because the person that was depreciating this particular plant is Shiba. The plant is for the subsidiary Shiba Limited, and Shiba is owned 75% by the Pika and 25% by NCI. So we shall remember to apportion that. Number 2, the intercompany sales, specifically unrealized profit. Let me just write intercompany sales, and in this case for the intercompany sales, you'll find that in note number 2, on 28th April, Shiba sent goods at an invoice price of 7 million to Pika. So it was Shiba selling to Pika. Shiba to Pika. Yeah, Shiba to Pika Limited. It is an upstream transaction because it is a subsidiary selling to the holding, and the selling price was 7 million. The selling price was 7,000 in this case, selling price of 7,000. Shiba to Pika, selling price of 7,000. The other thing they are telling us, there was a markup. First, the items were not received. Yeah, Shiba had sent 7 million to Pika, which Pika Limited neither received nor recorded until 5th May. Shiba Limited had marked up the goods by 25% on cost. So we calculate what we call the UPCS, unrealized profit on closing stock, unrealized profit on closing stock. And in this case, it will be the 7 million. Remember, it was a markup of 25%. It was a markup of 25%. So shall multiply by 25 over 125 because it was a markup. The aim, we just need to identify the profit element that was not realized. The profit element that was not realized out of the total profit. If they were to sell, and remember now, because the items has not reached the Pika Limited, then the whole amount will be unrealized. The whole amount will be unrealized. So that means the proportion that was unrealized was 1400. And still, we shall remember to apportion this because it is Shiba that is selling. So the unrealized will be reported by Shiba Limited. Shiba Limited is one that will report the unrealized profit. I think those are the two main. The others we shall calculate as we move on, because the aim is to get maximum marks. Because when you start doing all the workings, you may end up doing the workings alone and not transferring them to the final statement. So the two of them will enable us to continue with our statement. And we shall start with the non-current asset that we have, and I will just deal with one column. Non-current asset, shillings in 1000, and the first element we have is a PPE. Remember, just dealing with simple addition and doing the adjustment where necessary. Simple addition with the necessary adjustment. Our PPE, we add the one for Pika and we add the one for Shiba. Pika plus Shiba plus the fair value. I think fair value, I did not write it somewhere, so I'll just add the 10,000 in note number 1. This one had a fair value of 10,000. Call it fair value uplift because the PP will increase by that's like a revaluation, 10,000. And now we minus the depreciation. Remember, out of this 10,000, it depreciated by what? 500. So during the year, it depreciated by 500 for those particular 6 months. So you have taken the value for Pika, added the value for Shiba, added the fair value uplift, 10,000, which was a gain, and you minus the depreciation of 500, and I'll just enter. So that one will be our value of PPE, the value of PPE. You just format this cell, need the 1000 separator, and I don't need the zeros. Yeah, that way. Then after PPE, what else? So the investments, remember already these two we said we have already used. investment in Shiba and in Amua, because we used them to calculate the goodwill and to calculate the value of investment. So these two are the ones that we shall report here. Report the goodwill that already we had calculated. So the goodwill of 40,600, and the investment in associate, investment in Amua, investment in Amua Limited, investment in Amua Limited. This one already you have calculated here, 22,600. So here the PPE, we had the goodwill and the investment in Amua Limited. Just need to get the total for that. That is our non-current asset. The total for non-current assets. Total for non-current asset. So we now calculate the current asset. Just pick the heading because already we have it here. Current asset. And for current asset, the first item we had inventory. Yeah, these ones are not changing. So inventory, I'll pick the next receivable, and I pick, could have copied everything. I pick this, and I pick what else? I pick the total. I pick the total assets, so that when you just start putting the figures, so just put the figures. Yeah, so you need to put the inventory, the receivable, and the cash and cash equivalent, and the total asset. You need to create another column here. Yeah, for these two, or you can even put them directly in one column, but when you, because you are just consolidating, two columns will serve as well for the current asset. So that for the inventory, so Picker had an inventory of 28. We add simple addition for Shiba, and we shall add the goods in transit. Remember, there were some goods in transit. The sales, this one, the intercompany sale from Shiba to Picker, they were in transit. Shiba had already released the good, but Picker is yet to release. So when we are doing consolidation, we assume already the goods were already received. So we shall add those goods, the 7,000, and we minus the UPCS. So we are adding Picker, inventory for Picker, inventory for Shiba, adding the 7,000, the goods in transit, and we minus the unrealized profit, so that we can get the closing inventory. Remember, the assumption is the goods have already been received, even if they're in transit. Remember, one company has already released them and they have reported as if they have made a profit, but the other company is yet to receive the goods. The second part for our receivable for Picker was 27. We add the one for Shiba, and remember, normally the rule is that anything that is intercompany we normally eliminate. Intercompany transactions are normally eliminated. So the 7,000 that we added in the inventory, it was just an accounting double entry to show that already we have received. Later on, we eliminate them. We eliminate them as part of our intercompany balances, the 7,000, because we are yet to pay and we owe the other book or the other company. So we eliminate them. And when you read note number 2, it's note number 2, where Shiba sent goods at an invoice price of 7 to Picker, which Picker Limited neither received nor recorded until 5th May. Shiba Limited had marked up the goods by 25%. That's why we're eliminating, because they were at invoice price, we're eliminating the profit it was yet to be realized. The agreed trade payable recorded in the books of picker before the above transaction was 6 million. So it was before. That's why we are minusing these, so that it will cancel with the amount in the inventory. And again, we minus the 6 million that they had already agreed. Remember, 6 million was before the 7,000. 6 million was before the 7,000. It was before the 7,000. So that's why we are picking now the one for picker, the one for Shiba, minusing the 6 and minusing the 7 and the 6, the 7 and the 6, 7 and the 6, and I will enter. So that will be our trade receivable. It will be our trade receivable. Trade receivable. Then the cash, no adjustment, just need to add the cash, just a simple addition between the two, because there was no cash in transit in this question. Just a simple addition for the cash for the subsidiary and the cash for the holding. You just need to get the total for the two, and I will enter. It will be 97, and I will get the total here for these two, and I will enter, which gives us 406,000 as our total assets. So that's the first part of the accounting equation, where we have already the total assets. We have gotten the PPE, the goodwill, the investment in Amua, the inventory, the receivable, and the cash and cash equivalent, and it's after doing the adjustment. Remember, we have adjusted the receivable, we have adjusted the inventory, and we have adjusted the PPE. Goodwill we had already calculated, and investment in Amua we had already calculated. So we go to the other part. The other part for the equity and liability. Equity and liability. Under equity and liability, we start with the ordinary. Ordinary shares. We shall deal with ordinary shares, and later on we shall deal with the retained earnings. Let me first deal with the ordinary. One of the rules when we are dealing with consolidation is that for the ordinary we normally take for the holding, only for the holding company or the parent company. That is if we are dealing with cash transaction. We are acquiring the subsidiary using cash. If we are acquiring the subsidiary using cash payment only, we shall only show the capital or the ordinary share capital for the parent company, share premium for the parent company. That is when you're dealing with only the cash consideration. But when you're dealing with the share exchange, then it means we give them shares. The effect of that, our shares will increase, and therefore we have to show the shares that we had at the beginning plus the new shares that we issued to acquire the subsidiary. So that's not consolidation, but we are just adding the shares that we gave them, because the effect of that, our shares will increase. The shares will increase, and that applies to this question where we had an option of share exchange here. So the total number of shares were 46,800. Let me just deal with that here. Number 3, share exchange transaction. Share exchange transaction. The share exchange transaction that we had, I'll just break it down. The amount that went to the ordinary, remember ordinary shares, we are maintaining it at par. Ordinary share capital is normally maintained at par. Any amount issued above the par value, is supposed to be recorded under the share premium account. Any amount above the par value recorded under the share premium. So here we shall have our ordinary shares. And for the ordinary, the total number of shares that we had for Shiba, there were 80,000 at a par value of what? 10. The par value was 10. 80,000 divided by 10. When you divide, it is giving us the number of shares. We shall read bullet 2 at the beginning of the question, where, remember, we finance acquisition of Shiba using two ways. The first one was an immediate cash payment at a fair value of 13, and the second one was an issue of 3 ordinary shares of 10 par value in Pika for every 5 shares acquired in Shiba. For every 5 shares acquired in Shiba. Remember, we acquired what? 75%. So we are taking 80,000 divided by 10 multiplied by 75%. What we did by 75% to get the number of shares that we acquired. After getting the number of shares that we acquired, you multiply by, we gave them 3 for every 5. 3 for every 5. 3 for every 5. And they were fair valued at what? 13 shillings. They were fair valued at 13 shillings. And remember, our par value is 10. And ordinary, we have said, is we are maintaining it at 10 shillings. So ordinary share, we shall multiply by 10. So 80 divided by 10, we get the number of shares we took. We acquired 75%. We gave them 3 for every 5 at 10. So that one will be 36. 36,000 will go to the ordinary shares. That 6,000 will go to the ordinary. The balance goes to share premium. Share premium. The share premium account. And for the premium, the same process, or you can minus. The same process is 80 divided by 10. We acquired 75%. We give them 3 for every 5. And now the shares, the fair value was 13. 10 shillings already we have accounted for it under the ordinary. The balance of 3 shillings, the excess above the par value, which is 3 shillings, will go to the share premium, and we'll get 10,800. So that the sum of the two is 46,800. Remember, this one we are just dealing with a breakdown. It's just but a breakdown of the value, how we arrived at this value, the 46,800. The share exchange, the total value was 46,800. When we break it down, ordinary share, we shall account for 36. Share premium, we account for 10,800. 10,800. So with that in mind, we shall come back.
Excuse me.
Yes.
Oh, I wanted to just put the cursor on the 10,800. I see something.
In 10,800. Okay.
Okay.
So checking. It's okay. 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 So we now consolidate them here. So our ordinary share, therefore, will be, we take the ordinary share for Pika, which is our holding, and we add the ordinary shares that we issued as part of the purchase consideration. We add ordinary shares that we issued as part of the purchase consideration. Remember, for the ordinary, I said we are not doing consolidation. We are only adding that because we issued it as part of the purchase consideration. As part of purchase consideration, we had the share premium that has arisen as a result of the purchase consideration. We shall account for it. The share premium of 10,800. Remember, initially we did not have share premium, but because of the shares that we issued to them, then we are having a premium of 10,800. Then we calculate the retained earnings. Retained earnings. I'll do that as a working. Let me do that as working number 4. Retained earnings. And for this one, we have for Pika Limited, we just pick directly the profit for the whole year for Pika. Remember, they had broken it down for 1st May and for the year ended 30th April. The reason it was to assist us for Shiba because we acquired it in the course of the year. So here we shall consolidate. For Pika we just add at the beginning and the one for the year. At the beginning, and you add the one for that particular year. The one for that particular year. But when you come to Shiba, for Shiba Limited, remember we acquired it in the course of the year, and because we acquired it in the course of the year, the profit for the year is the one that we shall deal with it. The post will be the profit for the year. Remember this one for Shiba, the retained earning here is a post acquisition. You can just show that this is a post acquisition. Remember here we use the pre. When you are calculating the goodwill, we use a pre, and the pre, if I can click here, you can see we used D25. The opening here, we can just double click this. It will show that we used this opening plus half, D26, half of this. It means the remaining half was the post, because we acquired it in the course of the year. And therefore our post will be the 10,800 by half, or 0.5. That one will be our post. That is from November to 30th April 2023. From November to April 2023, the profit that we made for that particular period forms part of our post acquisition profit. Amua Limited, Amua already we had calculated. Amua, whatever we used here as a post, when we are calculating the investment, the post acquisition profit of 600, we shall report it in the retained earnings, consolidated retained earnings. The one for Amua, remember even for Amua was for 6 months, 30%. The way we arrived at the 600 we took in note number 5. During the year they made 4 million. I can just show here, they made 4 million, but we took for 6 months, and 30% what we are owning, we were owning 30%. So that's how we arrived at 600 for 6 months, the proportion that we were owning of 30%. Then we had impairment. Impairment of Amua. Remember, it will reduce the value. For Amua. Amua had an impairment of 2. It had an impairment of 2 million, so it will reduce the value of Amua, and that's why we are putting it as an expense. And the other one is a depreciation, fair value depreciation. The fair value depreciation, we take our portion for the fair value depreciation. So to log you out, then you shall log in to complete this. But I can pick these. Remember, depreciation for plant was 500, and we are owning it what? 75%. We are taking our portion because we are saying the plant was for the subsidiary. And depreciation is an expense, so we need to minus that. Value. So fair value depreciation we are minusing because it is an expense. Then we shall have the UPCS. Our UPCS, again we shall pick our portion for the UPCS. A negative, again it is an expense. And realized profit, you normally expense it because it was not realized. Retained earnings, we have said you have started with picker. We have picked the value. Shiba, the post acquisition for 6 months. Amua already had calculated, but I've shown you how we arrived at 600. And impairment, we have taken the impairment for Amua, and the fair value depreciation already you have calculated. The fair value depreciation, you are calculating now the UPCS, the unrealized profit on closing. which we are picking the 1400, and we take our portion 75%. We take our portion of 75% because it was a Shiba. Remember, we are supposed to put it as a negative because it's an expense. We are expensing it. It was a Shiba that was selling to picker, so we just pick our portion of that. Goodwill was not impaired. I think they are the only expense that we have there. And just add that to get 86 as our retained earnings for that particular part. Our retained earnings. So our retained earnings, we'll pick that of 86. So this one gives us attributable parent, attributable to holding, attributable to holding company. So these are net assets that are attributable to holding company. The reserves for the holding company. Here we have 293,475. We calculate the NCI. NCI share of net asset. NCI share of net assets. NCI share of net assets. We do that, the last thing should be the last working number 5. NCI share of net asset. Remember, net assets are the reserves that we are having. And remember, there are normally again two approaches for accounting for NCI. We either take the proportion of net asset or we start with the fair value. Whenever we are using the full goodwill, the NCI share, we shall account for it using the fair value. Where we had the fair value here, fair value NCI, we had already calculated it under the goodwill fair value NCI. So that's the value we shall start with, 24,000 here, the fair value of NCI. And we pick again the profit for Shiba, the post. They'll pick their share of Shiba Limited post acquisition. Shiba Limited post acquisition profit. Our share now. Our share. Okay, so it means, just a minute, the 54 that we took was only half. It was only half. I will adjust that because you're supposed to take our share of Shiba Limited post acquisition. I will multiply this by 75. Sorry, and adjust that by 75% because we normally take the share of the retained earnings. The share of the retained earnings, and the best thing, when you adjust that, it will adjust 85, and even here it will automatically adjust to 85, so that the same will apply to the NCI. I will pick the profit for the year that we had for Shiba by 6/12 or by half, 6 months by 25%, because for this one they are taking 25%, which will be 1350. Remember, here we have taken 40/50, so 1350 will be for Shiba. Then we pick the fair value depreciation. Fair value depreciation. The total fair value depreciation was 500, but here we are picking our value, the 25%, and we're supposed to pick it as a negative. 25% of that, and they pick the UPCS. Our value of the UPCS, again a negative. negative, depreciation was 14, and I will multiply by 25%, 5%, which will give us the 350, and I think that's all that we had for the NCI. Remember, when you are dealing with the proportionate share of net assets, that time they normally share even the fair value gain, they normally share, but in this case we are using the fair value NCI already have been given, so we don't include the fair value of net asset, because already the assumption the fair value has captured that. It has captured that. So that is our NCI share of net asset. Close NCI share of net asset. So I'll include our value here, which was this one, 24. We shall get our shareholders fund. So for shareholders fund, the sum of the two, 317. We'll just use the top border for that. Then after shareholders, we have the non-current liability. This one, and we pick the 10% bank loan. 10% bank loan. For the bank loan, it's just a simple addition. So we pick this and we add this value. That's why we are calling it a simple addition. It will usher us to current liability. Well, for the current, there are two items. First, pick the trade payable and the current tax payable. These two, I'll do them in this column. For our payable, we deal again with simple addition, payable here, and we add this. And remember, we had an intercompany what we are owning one another. The 6,000 that was captured in note number 2, and they are saying the agreed trade payable recorded in the books of picker before the above transaction was 6. Remember, the 7 cancelled each other because we added it in the inventory and later we eliminated it from the receivable. So that was a nil transaction because it cancelled out each other. But the only item that you have not have the double entry is the transaction for 6 million, where we deducted it in the receivable, and therefore we are supposed to deduct it even in payable, the 6 million. So that we shall remain with 44,000, and we calculate the current tax. Current tax payable, just a simple addition for the two. To get 32. I think we have included everything. Everything has been taken care of. Yeah. So I'll add these two. That one, and you shall get the total in this end. Total equity and liability. We'll add this and get we have 399. So there's a difference, but we shall look at the difference. So 399, 200, and here is 406. 406. So the difference is, find the difference. So you're having a difference of 68, a difference of 68. Just counter check, either there's something that we have left out. Just a minute. In our working UPCS you have captured 500. Okay, UPCS 1050, and I think I've captured everything. Just to wonder why. Yeah, we had deferred tax, sorry. Yeah, under non-current liability there was a deferred tax. I think that's the element that we are missing. I will include it here. I will insert a row for the deferred tax. So let me eliminate these so that I use at this end. Let me start adding the bank, and I add this. Then we have the deferred tax. The deferred tax, it was just again a simple addition for the deferred tax. Deferred tax, we had this and we add this. Yeah, those two, so that the two of them shall add them here. Alt equals the sum of these two. You'll find that when you have this already, this one is 406,000. That's how that question was supposed to be calculated, or that's how this question was supposed to be tackled. The group question, it was only one-sided because we were only calculating the financial position, and it was broken down to calculation of goodwill and determination of the investment in Amua Limited. So any question as far as